Welcome back to the deep dive. It is Wednesday, February 4th, 2026. And today we are doing something that, on the surface, sounds like the absolute driest topic we could possibly pick.
I know.
We are reading an earnings report from a credit reporting agency.
You say Equifax Q4 earnings. And yeah, most people instinctively reach for that skip button. It sounds like homework.
It really does.
But stick with us, because this isn't really about accounting.
No, it's not. It feels more like, I don't know, a dispatch from a battlefield.
Yeah.
We were going through the notes in the transcript this morning, and this report is actually a window into the plumbing of the entire U.S. economy right now.
It really is.
We found a price war over credit scores, a massive government crackdown on fraud, and frankly, one of the most realistic looks at how AI is actually being used in corporate America.
Not just the hype, but the actual, rubber meets the road reality. It is a fascinating document. If you want to understand why the economy feels the way it does right now, kind of weirdly frozen, but also somehow resilient, this report explains a lot of it.
It connects the macro vibes to the micro data.
Yes, perfectly put.
So here is the mission for this deep dive. We need to figure out how Equifax, a company that theoretically depends on people buying houses and getting jobs,
Big stuff.
managed to beat Wall Street's expectations when both the housing market and the hiring market were basically stuck in the mud in 2025.
That is the central mystery. The headline numbers are surprisingly strong.
They really are.
They reported revenue of, $1.551 billion, which is up 9%, and earnings per share of $2.09. They beat the street.
Which brings us to the vibe check. Because if you ask the average person on the street how the economy felt in 2025, or even right now in early 2026, they would not say up 9%. They'd probably say expensive or stagnant.
Definitely not screaming growth. And that is where we have to start that disconnect. To really appreciate this beat, you have to look at the mess they were operating in.
The headwinds.
The macro headwinds, exactly.
Right, let's look at the housing market specifically. Historically, Equifax is the mortgage guys. You want a house, you need a credit report. That's the classic business model. But in 2025...
the market was shrinking. U.S. mortgage market credit inquiries were down 7% for the year.
Wow, 7%.
That is a significant contraction. That means 7% fewer times a bank asked, can this person afford a house?
And hiring, because they track that too.
Also down. U.S. hiring decreased about 2%.
And we all know why housing is down. It's the rates. It feels like we've been talking about this for 3 years now.
It is the lock-in effect. And the numbers in this report, they really illustrate it starkly. They laid it out clearly.
What were they?
Right now, there are over 13 million mortgages with interest rates over 5%. But, and this is the kicker, almost 8 million with rates over 6.5%.
So if you have a 3% mortgage from a few years ago, you are not moving. You are staying put.
Not a chance.
And if you have a 7% mortgage now, you can't refinance because rates just haven't dropped enough to make it worth it. The market is just stuck.
Exactly. The refinance market is basically non-existent. It's dormant.
So if you are Equifax and your two biggest triggers for making money, someone applying for a mortgage or someone getting a new job, are both flashing red,
White.
how on earth do you grow revenue by 9%?
That is the million-dollar question. Or I guess in this case, the billion-dollar question.
So is it just pricing power? Or did they find a completely new way to make money?
A bit of both, but mostly it's a strategic shift they call diversified markets. They saw this coming. They have spent the last few years frantically trying to decouple their business from the interest rate cycle. They realized, we can't just be the mortgage folks anymore.
So what are they now? If I'm not buying a house, how are they making money off of me?
They are the everything else folks. Their non-mortgage revenue actually grew 6% in the fourth quarter.
So what does that include?
We are talking about auto loans, credit cards, debt services. Those sectors were up double digits.
That paints a very specific and honestly kind of relatable picture of the American consumer right now.
It really does.
We aren't buying houses, but we are definitely putting groceries on the Visa card, and we are buying cars.
And sadly, we are dealing with debt collections. Equifax monetizes the entire life cycle of debt.
So whether you are getting the loan, paying the loan, or defaulting on the loan,
there's a data point they can sell.
So they have hedged their bets. If the economy is booming, they sell mortgage reports. If it's struggling and people are relying on credit, they sell data to card issuers and debt collectors.
Precisely. It's a portfolio approach.
Yeah.
But, and this is where it gets really counterintuitive, even within that frozen mortgage market, Their mortgage revenue grew 20%.
Okay, wait. You just said the mortgage market activity was down 7%.
It was.
How does their revenue go up 20% in a shrinking market? That math doesn't add up unless they are charging drastically more money.
Bingo. You hit it right on the head. And this brings us to the biggest drama in this entire report.
Okay.
It is the Game of Thrones happening inside the credit scoring world right now. We need to talk about FICO.
The FICO score, the 3-digit number that rules our lives. I saw in the notes that there is a price war happening.
War might be too soft a word. It's more of a siege. FICO is the company that creates the algorithm for the score. They have massive market dominance, and in 2025, they decided to flex that muscle.
How so?
They raised their prices.
How much are we talking? Inflationary adjustment, 5%.
Try 100%. In 2025, a FICO score for a mortgage cost roughly $4.95. In 2026, it is $10.
They doubled the price, just like that.
Overnight. And here is where it gets tricky for Equifax. Equifax is the distributor. They buy the score from FICO, put it on the credit report, and sell the bundle to the bank.
So Equifax is just the middleman here. Do they add a markup? If FICO charges 10, does Equifax sell it for 12?
No. And this is a really important detail for understanding their financials. They pass that cost directly to the customer with zero markup. They call it a pass-through.
Why would they do that? Why not make a buck on it?
Because they are already under pressure. Lenders are furious about the price hike. I mean, mortgage originators are running on thin margins as it is.
So if Equifax added a surcharge,
The lenders might revolt. So Equifax says, hey, don't look at us, we're just passing the bill along. This is FICO's doing.
but that has to mess up their accounting, right?
It creates what we call empty calories or zero-calorie revenue.
Okay, explain that.
Think about it. Equifax collects that extra $5 from the banks, so their revenue line goes up. It looks like growth, but they immediately hand that $5 to FICO. So their profit stays exactly the same.
So the top line looks inflated, but the bottom line, the profit margin, actually looks worse because the revenue number is bigger, but the profit dollars didn't change.
You nailed it. It's a
Yeah.
denominator problem. This pass-through revenue is actually dragging their 2026 EBITDA margins down by over 200 basis points.
Wow.
It makes Equifax look less efficient than they actually are. If you just looked at the margin percentage without context, you'd think, oh, their costs are spiraling.
But really, they are just acting as a bagman for FICO's price hike.
That's the perfect term for it.
That has to be frustrating for them. Being the bagman is never a fun job, so surely they aren't just taking this lying down.
Oh, absolutely not. That is where the war comes in. Equifax is betting heavily on an alternative. They are aggressively pushing a competitor called VantageScore.
I feel like I've seen VantageScore on my banking app. It's the free credit score you get that isn't the real FICO score banks use.
That has been the perception for years. FICO is for lending, Vantage is for education. Equifax is trying to break that wall down.
And how are they doing that?
They are currently running what is essentially a massive Pepsi challenge for lenders.
How so?
They are offering a free VantageScore 4.0 with every paid FICO score.
Ah.
They are basically saying to the mortgage lenders, look, you are already paying $10 for the FICO score because you have to. Here is the Vantage score for free. Just look at it, compare them, see if it predicts defaults just as well.
That is the classic drug dealer tactic. First one is on the house.
It is effective. They have over 200 mortgage lenders currently testing or in production with Vantage.
200.
And the financial incentive for Equifax here is massive.
Mm.
If they can get the market to flip, if lenders start using Vantage instead of FICO Equifax estimates, they would gain about $160 million in EBITDA in 2026 alone.
160 million. Just by switching the algorithm.
Because they wouldn't have to pay FICO that huge licensing fee. You see, Equifax owns a piece of Vantage score. It changes the economics completely.
So it turns a low-margin pass-through into high-margin profit.
You got it.
But there is a massive hurdle here, right?
Yeah.
The government, Fannie Mae and Freddie Mac, the entities that buy most of the mortgages in this country, they require FICO.
That's true.
A lender can't just decide to switch on a Tuesday.
That's the big wall. But the regulatory winds are shifting. The FHFA, the regulator, has signaled they are open to Vantage. It is a slow process. And Equifax's guidance for 2026 assumes zero conversion just to be safe.
But if that dam
The
breaks,
government says Vantage is okay. It is pure upside for Equifax.
it is wild to think that the three-digit number that dictates whether you get a house or not is essentially the subject of a corporate wrestling match right now.
It really is.
Yeah.
And FICO knows they are being targeted. They are trying to cut out the middleman, too. They have this FICO Direct model where they want resellers to calculate the score themselves.
Changing the whole supply chain. And how does Equifax feel about that?
They played it very cool in the earnings call. The CEO, Mark Bigor, basically said they are agnostic.
Agnostic. That sounds surprisingly zen for a company in a price war.
It's a power move.
Yeah.
He is saying, look, you can calculate the score. We can calculate the score.
Yeah.
We don't care because Equifax makes its real money on the credit file.
The data, it's...
The actual data of your payment history. You can't calculate a score without the raw data.
Right. The algorithm is just a recipe. You still need the ingredients. And Equifax owns the grocery store.
Exactly. Do whatever you want with the math, but you need our numbers to do it. That is their moat.
Speaking of moats and data, let's pivot to the part of the business that seems to be quietly becoming their most valuable asset.
Yes.
Because looking at this report, it isn't the credit reports that are the star of the show, it's Workforce Solutions, or EWS.
This is the jewel in the crown. It is their employment and income data business. Think the Work Number database. Revenue for this segment was up 9% in Q4, which is good.
But the margins,
But look at the profit margins.
I'm looking at 51.3%.
Yes, 51.3% EBITDA margin. That is software-level profitability. That is better than most big tech companies.
How do they have that kind of margin on data?
Because they have built a database called the Twin. It now has 209 million active records and covers 105 million unique Social Security numbers.
And this is where you work, how much you make.
When you got a raise, when you got fired, and they get this data directly from the payroll processors.
So it's verified. It isn't self-reported, I promise I make 100K. It is the actual pay stub data.
Correct. And in a volatile economy, that verified stamp is worth its weight in gold. But here is the fascinating shift. Who do you think is the fastest growing customer for this data?
Well, you think banks.
It isn't banks.
Okay, employers.
It's the government. Government revenue within this segment was up low double digits.
The government. Why does the government need to buy data from Equifax? Don't they have the data? They are the government.
You would think so. But the government's data is often siloed and slow. The IRS knows what you made last year. They don't know what you made last week.
Right?
And this is where the story pivots from lending to fraud.
Fraud.
The U.S. government loses an estimated $162 billion annually to improper payments,
162 billion.
which is the polite term for fraud, waste, and people claiming benefits they aren't actually eligible for.
That is a staggering amount of wasted tax dollars. That's bigger than the GDP of many countries.
It is massive. And honestly, it's been an issue for years. But recently, there was a legislative hammer dropped. In July 2025, a bill passed called OB3.
Sounds like a droid from Star Wars.
It does, but it's actually boring legislative housekeeping that has huge implications. It essentially forces states to check eligibility for social programs like SNAP food stamps more frequently.
Oh, interesting.
It used to be that once you were approved, they might check on you every 12 months. Now, for many cases, they have to check every 6 months.
So the states are panicking. They need to know, did Bob get a job last month? Did his income go up? Is he still eligible? And they need to know it now, not next tax season.
Exactly. And Equifax is standing there raising its hand saying, we have that data. We know Bob got a job at Home Depot last Tuesday.
So they created a product for this.
They launched a product specifically for this called a continuous evaluation solution for SNT.
Continuous evaluation. That sounds intense.
It is. Instead of a yearly checkup, it's constant monitoring. Equifax alerts the state the moment income changes.
That is a huge pivot in business model. I always think of Equifax as the company that helps me get a loan.
Right.
But really, they are becoming the company that helps the government catch me if I lie about my income.
It's a brilliant hedge. Think about it. In a high interest rate world where lending is slow, banks aren't buying as much data.
Sure.
So Equifax found a customer that has infinite pockets and a desperate, legally mandated need to cut costs. The U.S. government.
It's smart, but I have to play devil's advocate here.
Go for it.
We are talking about all this data income, employment, credit history. We are living in 2026. Can't AI just scrape this stuff? Why do we need Equifax?
This is the elephant in the room question. Is AI an existential threat to a legacy data broker? If data is free, is Equifax dead?
Right. Information wants to be free, as the saying goes, and AI is really good at finding it.
Equifax's CEO addressed this head-on,
Hmm.
and he used a phrase that I think is going to define the next decade of tech,
What's that?
the walled garden,
The walled garden, meaning keep the AI out.
meaning the AI can't get in. He pointed out that 90% of Equifax's revenue comes from proprietary data, only Equifax data.
So it's not public.
You cannot scrape private payroll records from the open web. It isn't on Google. It is on LinkedIn. It is locked inside the payroll processor's servers, and Equifax has the exclusive contracts to see it.
So AI models are hungry for data, but they can't eat if the fridge is locked.
Precisely. So rather than being threatened by AI, Equifax is actually using AI to turbocharge their own operations.
A tool, not a replacement.
Exactly. This was one of the more surprising stats in the report for me. They have 1,900 software engineers using AI coding tools right now.
1,900. That's an army. What are they actually producing?
They have generated over 1 million lines of code using AI, and they claim this is going to save them $75 million in operating costs over the next 3 years.
And that's from what? Automating call centers?
Mostly in things like automating call centers and back office processing.
So they're using AI to cut their own fat. That makes sense for margins, but does it actually help the customer? Does it make the credit score better?
They claim it does. They have a platform called EFX.AI. They stated that all their new models built in 2025 use this AI platform, and they are seeing a 30% lift in predictive performance over legacy models.
30% is a huge jump in accuracy.
It's massive.
In the lending world, that is the difference between a profitable portfolio and a disaster. That means fewer defaults.
Exactly. If their AI can spot a risky borrower 30% better than the old model, that is a product lenders will pay for.
And they're patenting this stuff.
They hold over 400 AI patents now. So, far from being killed by AI, they're trying to position themselves as the ultimate AI-enabled data broker.
It sounds like they're trying to build a fortress. They have the data moat, and now they are digging an AI moat around it.
And they are measuring how well they are building that fortress. They use a metric called the Vitality Index.
Vitality Index sounds like something from a video game health bar.
In a corporate sense, it kind of is. The Vitality Index measures the percentage of their revenue that comes from products launched in the last 3 years.
So it tells you if a company is stagnant or if they are actually innovating.
Right. Are they just selling the same old stuff, or are they building new things?
Now, how do they score?
They hit a record 17% in Q4. Their goal is usually 10%.
So they're innovating faster than they planned.
Much faster.
What is an example of a new product in the credit world, though? It feels like credit reports haven't changed in 50 years.
The big one this quarter was the Twin Indicator.
Twin indicator. Sounds sci-fi again.
It ties back to that workforce solutions data we talked about. Historically, when a bank pulled your credit report, they saw your debts. They didn't see your income. They had to ask you for pay stubs later. It was a two-step process.
Right. The dreaded upload your W-2s phase of getting a mortgage. Everyone hates that part.
Equifax is now taking a flagging indicator from their employment database and sticking it right onto the credit report.
So when the lender pulls the file,
They'll see credit score, 750-80, income verified. Yes.
that speeds things up. But here's the kicker. How much do they charge for that little flag?
Nothing. They're doing it at no additional cost to the lender.
Free. Why give away the gold standard data?
Market share. Think about it. If you are a lender and Equifax's credit report tells you, yes, this person is employed and their income is verified, and TransUnion's report doesn't,
You buy Equifax.
which one are you going to buy?
It creates a preference. It
Yeah.
solves a headache for free.
Exactly. It forces lenders to choose them. It is a classic bundling strategy to lock out competitors. So like Microsoft throwing in Teams for free to kill Slack.
Smart. Okay, we have covered the strategy. Let's talk about the shareholders. All this maneuvering, the government contracts, the price wars, the AI coding. Did it actually put cash in the bank?
It did. Cash flow was very strong. They generated $1.13 billion in free cash flow in 2025.
$1 billion.
And they weren't shy about spending it. They returned $1.2 billion to shareholders through dividends and buying back their own stock.
That is a lot of cash, basically returning all their free cash flow to the investors. But I did see one little asterisk in the financials, a $30 million charge.
Ah, yes. The transparency note. They took a $30 million charge related to a legal settlement regarding inquiry disputes.
What does that mean in plain English?
It means people sued them because they disagreed with who was looking at their credit report or how those inquiries were recorded.
I see.
It's a reminder that being a data broker comes with regulatory baggage. When you hold data on every American, you are going to get sued occasionally. It's the cost of doing business.
Fair point. Okay, we have unpacked a lot here. The zero-calorie pass-through revenue, the government fraud pivot, the walled garden of data.
A lot.
If we zoom out, what is the big takeaway for someone listening to this deep dive?
The big takeaway is execution. Equifax is operating in a terrible environment for their core business. The housing market is frozen, hiring is slow, FICO is squeezing them on price.
And
yet, they grew revenue 9% and guided for 7% organic growth in 2026.
it is resilience. They found a way to grow when the soil was dry.
It is. But the so what for me is about the changing value of data. For decades, the most valuable thing about you was your credit history. Did you pay your bills? Now Equifax is betting the farm that the most valuable thing about you is your verified income.
Because in a volatile economy, knowing someone has money right now is more important than knowing they paid a bill 3 years ago.
Precisely. Verified real-time income data is the new gold standard. That is why the government business is booming, and that's why they are bundling that income data into everything they sell.
It is a fascinating shift, and it leaves me with one final thought, something to keep you up at night.
What is that?
We talked about the price war with FICO. FICO prices are doubling. Lenders are desperate. Equifax is pushing VantageScore hard.
Yeah,
We are on the brink of a currency war in credit scoring.
that is a great way to put it. We have relied on the dollar FICO for decades. Now someone is trying to introduce the euro.
Exactly. If VantageScore actually breaks the FICO monopoly in 2026, if we suddenly have two competing currencies for creditworthiness, are we ready for the confusion that is going to cause?
Oh, that's a good question.
Imagine applying for a loan and being told, well, you are a 750 in FICO, but only a 680 in Vantage, so we can't give you the house.
It would fundamentally change the language of lending, and millions of Americans might find themselves lost in translation.
It's something to watch closely as 2026 rolls on. Thanks for breaking this down with us.
Always a pleasure.
And thank you for listening. We will catch you on the next Deep Dive.